Steve, does the dollar keep falling?
Well, we think that the dollar is high, right? It's held on to levels that are essentially the third largest bull market in the U.S. dollar. It all depends on a couple of things. Again, Brexit, you can tell me. Where it is versus the euro, we see Europe has external surpluses, the U.S. Has deficits. Even with a U.S. interest rate premium, it doesn't really push up the U.S. dollar. But again, the major forces that would drop the dollar, right, would be the Federal Reserve easing a lot and staying easy for the long run. Take a look at the minutes of the last FOMC meeting when they talk about having easy, sustained policy for a long period of time. That's sort of the entrenched period of U.S. monetary easing where you tend to see the dollar fall. We're certainly not dollar bulls here from these levels, but I'm also not expecting this to be an immediately poor outlook for the exchange rate.
OK, so let's talk about some other unwinds that we could potentially see. You talked about UK assets a little bit earlier on. The valuation gap between the super expensive bond proxies and some of the cyclical names is enormous. When does that start to close? Is there an opportunity in the latter?
So what we've done in our asset allocation in the last 2 months is go from overweight global fixed income to underweight global fixed income, with the balance going into shares, some hedges, a little bit like gold, for example. But what we also did is go from an overweight position on defenses back to neutral and start to take a bit more cyclical risk. That's because of concerns about trade policy, monetary policy in the United States being somewhat reduced. And when markets go up, you never have enough of it, right? But, our basic view here, again, is that bond markets, the extremely expensive European bond markets, again, could be loss-making for investors, certainly holding them to maturity in the case of negative yield bonds. And we're seeing a bit of an uplift. You need another shock to hit to get these yields to fall back again. And for that reason, again, we're less optimistic on utility stocks, for example, which are trade fairly close to tech stock valuations. When you take a look at some of the other safer ones, we actually do see some reasonable dividend growth out of healthcare shares, for example, of course, and a bit in staples where valuations are higher. But again, as we move away from really pure bond proxies, we do want to take a little bit more cyclical risk, and we want to be in companies that pay a present income. That's not all promise for the future, but actually raise it. And that means a little bit more cyclical exposure.